Okay, stop what you're doing for a second.
Yeah.
We need to talk about the number 100, specifically $100. As of today, January 21, 2026, silver is knocking on the door of triple digits per ounce. And if you're like most people, you're probably looking at that vertical line on the chart thinking, okay, this is mania. This is 2021 all over again. It's a bubble, and it's going to pop any second.
It is the natural reaction, isn't it? I mean, we are conditioned to see vertical lines on a price chart and just expect gravity to kick in immediately. Usually when something is parabolic, the hangover is just around the corner.
Exactly. We've seen it with tech stocks. We've seen it with crypto. But today we are doing a deep dive into a report that says, not so fast. We're looking at an article by financial markets researcher Doug Young titled Critical Shift, $100 Silver Breaks Containment.
Arr.
And the core argument here is fascinating because it suggests this isn't just a price spike. It's a complete structural breakdown of how the silver market has worked for the last 50 years.
That's the key phrase right there. Structural breakdown. Doug Young isn't just saying buy silver or, giving a hot stock tip. He's pointing out that the mechanism that usually keeps silver prices in check, what he calls containment, has failed. We aren't seeing a standard bull market. We are witnessing an asset class transitioning from a speculative trading vehicle into a strategic national security material. And the market rules for those two things are completely different.
So our mission today is to figure out why silver is behaving so strangely. Why is it up nearly 150% in the last year? And why does this report suggest that the paper market, the contracts people trade on screens, is completely divorcing from the actual physical metal you can hold in your hand?
It really is a story of disconnects. Disconnects between London and Shanghai, between supply and demand, and between the old perception of silver as poor man's gold and its new reality as a defense asset.
Okay, let's unpack this first big concept. Breaking containment. It sounds like something from a sci-fi movie or maybe a virus outbreak movie. What does Young actually mean by that in a financial context?
Right. To understand breaking containment, you have to look at how silver has traded for, the last 40 or 50 years. It existed in what we call behavioral corridors.
Behavioral corridors. Is that just a fancy way of saying it went up and down in a predictable way?
Essentially, yes. Traders, and specifically the algorithms that, dominate modern markets, they relied on mean reversion. Think of it like a rubber band. If the price shot up too fast, the smart money would short it, betting it would snap back to the average. If it dropped too low, they'd buy. The market structure, mostly the paper markets in London and New York, kept the price within a comfortable expected range.
So traders basically had a playbook. Buy at the bottom of the channel, sell at the top, rinse, repeat. It was a contained environment.
Exactly. It was comfortable. But what Young is highlighting in this analysis is that the rubber band hasn't just stretched, it has snapped. The price action we're seeing now, sharp intraday advances followed by rapid recoveries and, crucially, failed sell-offs, shows that the old rules are gone.
Hold on. Failed sell-offs. That's an interesting term. Usually when the price dips, panic sets in and people sell, which drives the price down further, right? That's how a crash starts.
Correct. That's a liquidation cascade. But now we're seeing something weird. When the price dips, it immediately bounces back. The sellers just evaporate, or rather, the buyers are so aggressive that the dip lasts minutes, not days. There's a floor under the price that wasn't there before. It's no longer reverting to the mean. It's establishing a new reality.
The analogy that came to my mind when reading this was a pressurized water tank. For years, the price sloshes around inside the tank. It hits the walls and bounces back. That's containment. But if the pressure gets too high and busts a hole in the side of the tank, the water doesn't bounce back anymore. It shoots out.
That is a perfect visualization. And what we are seeing now is the water shooting out. The market is trying to find a clearing price, a price that balances the actual physical shortage, and it can't find that price within the old tank. The containment was the paper market's ability to dictate the price. That ability is gone.
And this isn't just a feeling or some chart astrology. There is some really weird, hard data backing this up. Here's where it gets really interesting to me. The report mentions a specific data point from early 2026 regarding the Shanghai Gold Exchange.
Yes, the SGE premiums. This is the smoking gun for the global fragmentation.
Right. The data shows that in Shanghai, silver was trading at premiums of up to $10 per ounce over the London benchmark price. Now, I'm not a professional trader, but isn't that free money?
In a functioning market, absolutely. It's called arbitrage. If silver is $100 in London and $110 in Shanghai, a bank or a trader would buy a ton of it in London, put it on a plane or a boat, ship it to Shanghai, sell it, and pocket the difference.
And that action buying in London and selling in Shanghai would raise the London price and lower the Shanghai price until they met in the middle.
Precisely. That is how global markets stay efficient. The prices equalize. But here's the problem. The gap isn't closing. The premium persists.
Why not? Is it just shipping cost? I mean, shipping's expensive, but it's not $10 an ounce expensive.
No, it's much deeper than logistics. We are seeing global fragmentation. That arbitrage is broken because the metal cannot move freely anymore. Asia, specifically China, is demanding jurisdictional custody.
Jurisdictional custody. That sounds legal.
It's geopolitical. It means they don't want a paper contract that says they own silver in a London vault. They don't trust that the metal will be released if things get heated politically. They want the metal physically sitting in Shanghai within their legal jurisdiction. They're basically saying, we don't trust your delivery system.
So it's a trust issue. They want the bars in their hand, on their soil.
They want the bars. And when you add in taxes, logistics, and increasingly soft export restrictions or friction, the idea of a single global price for silver is eroding. We are breaking into regional markets where the physical metal in a high-demand zone trades at a massive premium to the paper price in the West.
That is a huge shift. We're used to checking the price of silver on our phones as if it's one universal number, but you're saying that number might not be real depending on where you are.
Exactly, and it's not just the big exchanges feeling this. The report points out that major mints, like the Royal Mint in Britain, are struggling too. They've had to adjust pricing for their 2026 silver sovereigns because they literally can't allocate enough physical metal.
That's wild. The Royal Mint isn't some small coin shop. It's a sovereign entity.
That is the difference between a paper shortage and a physical shortage. When the Royal Mint says, we have to change our pricing because we can't get the metal to stamp the coins, that is proof that this isn't just numbers on a screen. The physical tightness is real. It's impacting the manufacturing level.
Which brings us to the aha moment of this entire deep dive for me. The reason why everyone from China to the Royal Mint is scrambling for physical metal. It's not just because people want pretty coins or jewelry. It's because of a decision made by the U.S. Geological Survey, the USGS, back in November 2025.
This is the game changer. This is the pivot point where silver stops being a commodity like corn or pork bellies and starts being a strategic asset.
The USGS officially added silver to the critical minerals list.
Finally. I mean, industry insiders have been screaming about this for years.
It joined copper and uranium. I mean, think about that company. Uranium is for nuclear power. Copper runs the electrical grid. And now silver is in that same club.
And rightfully so. For a long time, silver was ignored by regulators as just a precious metal, something for wealth preservation or decoration. But the USGS finally acknowledged the reality. You cannot have a modern defense system, you cannot have an energy transition, and you cannot have an advanced electronics sector without silver.
We usually hear about silver in solar panels, photovoltaics. That's the big consumer, right?
That's the big civilian consumer. But think about guidance systems for missiles. Think about satellites. Think about the contacts in EVs. Silver is the most conductive metal on Earth, thermally and electrically. It is irreplaceable in high-tech applications. You can't just sub in copper. It's not efficient enough for these high-performance uses. By designating it a critical mineral, the government is admitting this is a matter of national security.
Okay, so I get the status change. But what does that designation actually do? Does it change how I buy a silver coin? Or is this just bureaucratic labeling?
It changes the macro environment completely. Once something is a critical mineral, it opens the door for strategic stockpiling. Governments, not just the U.S., but globally, might decide they need a 5-year reserve of silver for their military industries.
Which sucks even more supply out of the market.
Correct. And it creates a completely different psychology. It raises the specter of export controls. If the US or Europe decides they don't have enough silver for their own domestic solar manufacturing or defense contracting, they could ban exports.
Which explains the hoarding we talked about earlier. If you're a big tech company or foreign government and you see critical minerals stamped on silver, you're thinking, I better buy this now before the government locks it down.
Exactly. Market participants become conservative, not conservative in their politics, but conservative with their inventory. They hold on to what they have. They don't sell because they fear they won't be able to buy it back later. That fear of government intervention creates a liquidity vacuum. Even if the price goes up, people aren't selling, which drives the price up even further.
Let's look at the math here because the numbers in the report are staggering. We mentioned silver is up almost 150% in the last year. But gold, which usually gets all the headlines, is only up 67%.
Which, to be fair, is a spectacular year for gold, but silver is leaving it in the dust.
And the supply deficit is, it looks bad. The Silver Institute Project's 2025 was the 5th year in a row where the world used more silver than it dug out of the ground. They're estimating a deficit of 180 million ounces. That sounds like a lot.
It's massive. That's roughly 20% of global annual production that we are missing. We are eating into above-ground stockpiles.
So here is the question every listener is probably shouting at their device right now. Economics 101 says if the price goes up, supply goes up. If silver is at $100, why don't they just open more mines? Why isn't the market flooding with new silver?
It's the right question, but it doesn't work that way with silver. And here's the why. And this is probably the most important technical takeaway for your listeners. The majority of silver production, over 70%, is a byproduct.
Byproduct. Unpack that.
It means most miners aren't actually looking for silver. They are mining for lead, zinc, or copper. The silver is just the extra stuff they find in the ore body. It's the icing on the cake.
So I'm a lead miner. My business model is based on the price of lead.
Exactly. Let's say you run a massive zinc mine. Silver makes up maybe 5 or 10% of your revenue. Even if silver goes to $200 an ounce, you're not going to double your zinc production and crash the zinc market just to get a little more silver. Your primary economics are tied to the base metal.
They can't just turn the dial up on silver without flooding the world with lead and zinc.
They cannot. And primary silver mines where silver is 80% of the revenue, are incredibly rare. Geology just doesn't put silver in the ground like that very often. So supply is inelastic. It doesn't respond quickly to price. We have a deficit that is structural. Mine output is stuck below 800 million ounces a year, but demand is exploding past 1 billion.
That is a fascinating constraint. I hadn't thought about the geology being the bottleneck. And I guess that explains the gold-silver ratio compression the report talks about. I saw it's down to about 50 to 1.
Right. For those who don't follow the ratio, it's just how many ounces of silver it takes to buy an ounce of gold. Historically, in the modern era, it's been all over the place, sometimes up to 80 or 90 to 1. Now it's tightening. We are seeing a reproportioning. The market is realizing silver was drastically undervalued relative to its utility. Gold is money, sure, but silver is money plus strategic utility.
It's the workhorse and the currency combined.
And in a crisis, utility wins.
That brings us to the bigger picture. We've got the supply crunch, we've got the strategic designation. But what about the human element? The trust element? The report mentions geopolitical influences driving this. It feels like we are in a very tense period globally.
This is the backdrop for everything. You can't separate the silver price from the geopolitical reality. We are living in a time of escalating trade frictions, particularly, as the source mentions, between the US and Europe, and obviously the tensions with Asia. We have tariff policies, sanctions, frozen assets.
It feels like everyone is fighting with everyone and using the financial system as the weapon.
Perfectly. And when nations fight using currencies and bonds, trust in fiat-linked assets erodes. If you hold bonds, you are trusting a government to pay you back. If you hold currency, you are trusting a central bank not to inflate it away. But when trade wars start and sanctions fly, that trust evaporates.
So money flows into things that are real.
Things with intrinsic utility. If the paper system gets shaky, or if you are a nation that thinks it might get sanctioned, you want the asset that is actually useful. You want the copper, the oil, the silver. This is the shift from financialized assets to hard assets.
It's a flight to safety. But safety doesn't mean treasury bonds anymore. It means physical stuff.
Exactly. And that brings us back to that disconnect we started with. Physical versus paper. The report says COMEX inventories are facing delivery pressures.
The COMEX is the main futures market in the U.S., right?
Yes. For years, it was a casino. People traded paper contracts there without ever intending to take the metal. It was just a way to bet on the price. But now, more people are standing for delivery.
They aren't rolling the contract over. They're saying, give me the silver.
They want the metal. And the inventories in the registered vaults are thinning. We are seeing a divergence where the spot price, the price to get metal now, is decoupling from the futures price. Eventually, the paper market has to break or realign with the physical reality. That is what Doug Young means by breaking containment. The paper market can no longer contain the price because the physical shortage is too acute to ignore.
It's like a game of musical chairs. For years, there were 100 people and 99 chairs, and that was fine. But now there are 100 people and 10 chairs, and everyone just realized the music is about to stop.
That's it. And the people grabbing the chairs aren't just day traders. It's the USGS. It's the Chinese government. It's global tech firms. The players at the table have changed.
So to recap this wild journey, we've gone from looking at $100 silver as a crazy speculative bubble to realizing it might actually be a delayed reaction to reality. We have a physical shortage that's been building for 5 years. We have a broken global arbitrage system where Shanghai pays way more than London because they won't let the metal leave. And we have the U.S. government officially declaring silver a critical mineral for national defense, effectively telling the world, we need this to survive.
It's a perfect storm, and honestly, it's a masterclass for the listener in how markets transition. It is messy, it is volatile, but it follows a logic. When the fundamental supply and demand get too far out of whack with the paper price, reality eventually wins. Gravity works both ways. Sometimes prices crash down to reality, but sometimes they rocket up to it.
And for everyone listening, whether you're an investor or just someone trying to understand the world, this is a reminder that the rules of the game can change overnight. What worked for 50 years, those behavioral corridors, that mean reversion, can disappear in a month when the structural dynamics shift.
And I think that leads to the most important question we should leave people with today. It's something I've been thinking about since I read the USGS report.
What's that?
If silver is now officially a critical mineral, essential for national security and the energy transition, and if governments are already considering stockpiling it to ensure they can build missiles and solar panels, how long will private individuals be allowed to trade it freely?
Whoa, that's a dark turn.
Think about it. If it's as important as uranium, do we let people buy and sell uranium freely on an app? No. If the shortage gets worse, does the government step in and say, we need this for the military, the market is closed? Or do they institute price controls or confiscation orders?
We've seen gold confiscation in the past, back in the 1930s.
Exactly. When an asset becomes a matter of national survival, the free market often gets suspended.
That is a heavy thought to end on. From poor man's gold to national security asset that you might not be allowed to hoard. Talk about a paradigm shift.
It's a brave new world for commodities. The free market might not be as free as we think when push comes to shove.
It certainly is a brave new world. Well, that's all for this deep dive. We'll be watching those charts and the USGS announcements very closely. Thanks for listening, and we'll catch you on the next one.